Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So the last week has been, again, another pretty uneventful week. We have had a little volatility up and down because of the latest talks that we're in with China regarding our trade imbalance, the fact that we import so much of their stuff and they don't really import very much of our stuff. Those talks are going to continue, but that's causing a little bit of concern in the markets, as well as the Federal Reserve has been putting some information out. And anytime the Fed talks, it really doesn't matter what they say. The markets get a little skittish because then people try to predict what's the Fed going to say. Are they going to raise interest rates? Are they going to start to increase the reductions in the balance sheet? All those kinds of things. So nothing really substantial to worry about, but just normal volatility. It is what it is. But that's not what I wanted to talk about today. Today, what I want to talk about is the concept of people are getting less in their federal tax refunds in 2018 from 2018's taxes than they had in the prior year. And the media has been reporting this as, it's a bad thing. Look how it shows, that tax bill that was implemented at the end of 2017, it's not helping anything. It's actually reducing the amount of refunds. And that's one take on it, but now I want to tell you why it's not a bad thing. So if you look at this chart, what you're going to see is that if you look at the amount of income people can earn and the tax rates that are applied to that income, what you actually see is that, say, for example, somebody making $55,000 a year, when you look at the tax rate that they would have had to pay in 2017, and you compare that to the tax rate that they paid in 2018, you'll see that the tax rate's actually lower. So what that means is that throughout the year, they were giving less money to the government because the tax rate was lower in 2018, so they got to keep more of their own money. So just common sense says that when you give less money to the government, when you go to file your taxes, your refund will likely be lower. That's not a bad thing. What seems to be missed here in many of our major media outlets is the concept of people got to keep more of their own money all year long. And we think that's really important because that extra money that people got to keep, they got to put into the economy, they got to go on vacations, they got to buy their significant others presents on Valentine's Day. It's just another way of giving people choices for what they want to happen with their own money. So as you look at the media and you hear people talking about, the statistics show people are getting smaller refunds than they had in prior years, just remember that's because people have been keeping more of their own money. By the way, one other interesting thing, I actually just had a conversation with a client about this, is that the standard deduction is now twice what it was in the prior year. So what that means is that a lot of people are not even going to have to itemize because the new standard deduction is like $12,000. So the old one was a little over $6,000. So that means that when you look at what your income is, you get to subtract $12,000 right off the top before you get to the money that would be taxable. And that's a good thing. It's just a good thing that people get to keep more of their money. So again, as the media talks about this, just remember, getting a smaller refund is not a bad thing. It just means that you gave the government less money. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching.